Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Gunn. Jumping into the charts on this November 1st. So the new month began today. Basically, it is pretty much a pause to lower consolidation day. Now, the interesting thing about today's price action is if we actually flip to the intraday chart, you can see we had a big gap up, which basically gapped into this gap, and then you pretty much made a little bit of an intraday high in the pre-market, and then you just started selling. You had 1, 2, 3, 4, 5, 6, 7, 8 consecutive, 9 consecutive 10-minute candles to the downside before you got your first bounce off of the intraday 200 moving average. But you've pretty much been seeing sell-side pressure all day long. Lots of bearish distribution signals occurring. You are forming a bear flag on the S&P 500. The markets still are technically holding a little bit of bullish consolidation above the 50-day moving average, but you are into some short-term resistance. And ahead of the Fed meeting, the markets are going to break either one way to the upside or to the downside. Now, considering you've had a pretty substantial move off the lows, I'm in the camp that we maybe see a little bit of an initial bump up into this trend line. You can see around this, maybe this 394 area. But then I think we're going to reverse, kind of like what we saw today. Despite the strength in the pre-market, with yields pushing down, the dollar pushing down, markets were ripping, and then they gave up everything. So we might see something along the lines where we see an initial pop, but I do think that's going to be met with more sell-side action tomorrow. The consensus is that we get a 75 basis point hike. I think there's a lot of exuberance in the market, feeling the fact that we're going to get a 0.5% hike. I'd be shocked if the Fed pivoted. Reason being is that Jay Powell doesn't know where headline or core inflation is going to peak at, so he would rather overdo it than underdo it and be known as the Federal Reserve chairman that let inflation out of control. So I do think that there's always the chance that they can basically over tighten, and then it's easier for them to pivot and start printing and supporting the markets with lower interest rates versus them having to let inflation run higher and have to tighten faster. So I think the 75 basis point is in the hike. Obviously, the market is going to be hinging on what he says in terms of what dovishness, maybe giving some forward guidance for the December meeting. But so far, the Fed fund rate curve is pricing in a 7.5 likely tomorrow, and then a 50 basis point hike in December. So let's just monitor the price action. There's going to be lots of volatility tomorrow come that 2:30 meeting, especially during the press conference, and then maybe slightly before there'll be some jawboning and backing and filling occurring. But overall, S&P is basically, you can see on a weekly chart, one of the reasons we're stopping at this level is you have the 25-day moving average, and you failed to confirm above that basically on all attempts. Over here you failed to confirm, over here you failed to confirm, and here you're trying to break that area, but it is proving to be resistance once again. I still think even if the Fed are more a little dovish, I still think we do see by the end of the year tagging this 325 level on the SPY, which would mean that there's a substantial drop still potentially to come. Now, what happened with this gap up and then crack? Basically, if we look at the US dollar, the US dollar did the inverse move of the markets. You can see that it was trending lower where the market was rallying, and then the US dollar spiked rapidly. And actually, the interesting thing about the US dollar is on an hourly chart, it confirmed a potential breakout. You have this left shoulder, this head, right shoulder over here, your first inverse head and shoulder. Target brings you to about this 112.50 area, and then you actually have a secondary inverse head and shoulder, which is this is your left, it's actually a bigger one, head, and then your right shoulder formation here. Here's your neckline, which you've actually broke out, confirmed on an hourly basis. You've had a retrace now back to that area, and even if you look on a slightly bigger 2-hour chart, you can see you got the confirmation breakout, retrace, and it does point to basically that fully measured move around 114 or 1/3, just shy of 114. You can see you have multiple pivot tops in that area. If the markets are to complete this first measured move, we're going to see tremendous downside in the overall stock market. Also, if you see the second move in the dollar go all the way up to this 113.96 level, that is going to put an exuberant amount of pressure on the overall markets, and we will see a sharp sell-off occur. So the technicals are pointing to potentially a more hawkish Fed than the markets and the stock market is anticipating, which is why it's so important to pay attention to these currency markets and the yields market. If we simply take a look at the US 2-year yield, which was falling sharply in the morning, and then it has completely reversed. So let's just see how important this is. So basically, from the overnight, yields were collapsing. Here was the low at 4.4. And the interesting thing is you had a technical gap over here around this 4.42 mark that needed to be filled. And we came down, we filled that level, and then you started to reverse sharply. And this reversal in yields came on the back of the jobs number being stronger than expected. So the overall mentality of the market, or at least the bond market, is saying that if the job market is stronger than expected, that means the labor market is super healthy, which gives reason to the Fed being able to tighten more aggressively and remain more hawkish. So the interesting thing about the 2-year yield is you have not retraced back to the breakdown zone. You can see that this yellow trend line is getting very close. That will be your first level of resistance. But the sheer fact that you've had a beautiful reversal on the daily chart just shows you the power of yields. The fact that you're closing above this consolidation breakdown zone is super bullish for yields, which means that the bond market is signaling a more aggressive Federal Reserve, which I think is not what the stock market has priced in. And we did mention a couple videos ago that there's a divergence between bonds and stocks, and the last 4 times we've seen that divergence occur where stocks go up, bonds go down, we've seen the stock market play catch up to the downside, which should mean there's lots of volatility. If we take a look at oil, oil has had a strong day today, but it looks to be that you're still inside of this, basically this nasty wide range red bar. The big question is, are we going to close above that wide range bar or inside? If we close inside, it's still interesting to note that you still have this little bit of a head and shoulders formation, which you played out to your downside target. Now you've had your bounce. You have not confirmed on the hourly chart above this neckline. So that means that the likelihood of continuing higher in oil is pretty slim on a technical basis for the intraday action. I still think we have to come down on oil. Probably going to see a sharp move down or up tomorrow. One way or another, oil is probably going to break out or break down with the markets. I'm in the camp that we see that breakdown occur. If you take a look at natural gas has had a whopping day to the downside. It was down over 10% at one point. Right now it's 7.78%, so it is substantially off the lows. You can see you got a retrace to fill this technical gap around the 580, and you actually hit the low of this wide range green bar. And it's impressive that you have had a technical bounce. So technically speaking, even with today's downside action in natural gas, you are still technically bullishly consolidating to potentially move higher. Now, the big thing is you don't want to see a secondary close below this downsloping red trend line. If you do see that, then that means that natural gas is likely to break even lower past these pivots. But for now, you have had a substantial bounce off of these lows, and it'll be interesting to see if we can recapture above that daily close on that trend line. Let's take a look at gold. Gold is pretty much strong today. It is showing great relative strength, even with a strong dollar. That is super impressive to see, as well as yields. But basically nothing new to report on gold. It is still holding these major pivot lows. That's pretty much your line in the sand. If you confirm below these, then you likely head back down to this 1540 area. Silver has also had a strong day. Initially, it has pulled off substantially off of the highs, but nonetheless, it is a positive day for silver, up over 2.77%. So good for our mining plays. Silver is still technically consolidating bullishly. It does favor a move to the upside based off of this healthy consolidation, and it just so happens that this is on a beautiful 1, 2, 3, 4, 5, 6, 7 day time count, which means that the 8th day tomorrow is likely to see a move for silver. If the markets sell off, which I think they are likely to, then silver is probably going to be under substantial pressure. There's a couple key support zones which we don't want silver to basically break, and it's this upsloping trend line, and then second you have this upsloping trend line over here. So those are the levels on silver to watch, and we'll just have to continue to monitor that. I want to show you a chart. The XLE is hitting major double top resistance today in an extended move. So that dictates that the probabilities of a pullback in energy is significant. And considering energy, the XLE is the leading sector in the S&P 500, you have to really be on guard when the leading sector hits major resistance and is likely to see a sharp pullback over the coming sessions. So if the XLE starts to fall sharply, that is going to substantially weigh on the overall energy sector and the S&P 500, which is why we are in the camp to the downside. You can see you had a double top retrace, and also this was your original basically topping formation, which broke over here, triggered to the downside, and you've had a beautiful retrace over here and now over here into a double top resistance, which should prove to be a pullback zone, at least down to this 83.20, which is about an 8.8% drop in the overall indices. If we take a look at Bitcoin, Bitcoin's kind of just been doing its own thing. It is still technically bullishly consolidating, but again, if the US dollar starts to rip tomorrow and indices start to sell off, Bitcoin should break lower. Okay, but if the Fed comes in more dovish and gives the market some reprieve, then you'll look for Bitcoin to break up and pretty much have a sharp, quick move up to this 22.4 level. Let me just take a look at the QQQ for us. The NASDAQ, basically you can see the NASDAQ has hit some resistance. This downsloping trend line, still technically it is in bullish alignment, but needless to say, if the NASDAQ falls tomorrow, big cap stocks will likely see massive pressure along with yield spiking, which should carry these markets lower in the event that the Fed is more hawkish. And I still think the Fed is going to remain more hawkish. Maybe they say that they're going to potentially pause before their next interest rate hike just to see it. But again, the narrative, considering the labor market is extremely strong, it provides the backdrop for the Fed to continue to be aggressive, because their two mandates are monitor inflation and monitor the employment rate. And considering employment is abnormally strong, historically very, very low, that does prove that the Fed still has a lot of maneuverability to hike, and it gives them the excuse to hike tremendously quickly. That pretty much covers it for today's video. Hope all this analysis helps, and we'll continue to accumulate shorts if this market goes higher. But overall, I am seeing massive distribution signals across many of the big cap names. Many sectors have hit major technical resistance, and obviously if yields are continuing to move up, which it's looking likely, then that means that the markets will see an abnormal amount of downside pressure in the near term.